welcome to the latest update from Rare Infrastructure. Today, Nick Langley talks to us about the Rare portfolio construction process and how that achieves good outcomes for our investors. Nick, thanks for joining us.
Thanks, Matt. I'm pleased to be here.
Nick, what are the key elements of the Rare portfolio construction process?
So, Matt, Rare is a value-based manager, and we tend to think about investments over a longer time horizon than the rest of the market. Market's generally focused 1 to 3 years. We're in that 5-year time horizon. And so our portfolio construction process focuses on the bottom-up analysis, the returns that we expect over a 5-year period, balanced against the risk of us actually receiving those returns in the portfolio.
Nick, can you just explain to us the bottom-up portion of the process?
Sure. So the bottom-up portion of the process really focuses on the returns that we expect to receive over a 5-year period. There's 2 components to it. Firstly, the income or the dividends that you expect over those 5 years. So what's the dividend yield that the company is going to pay us? What are we going to receive over the 5-year period? And then secondly, the capital return. So we've got a share price today. What's our target price in 5 years' time? So what element of capital growth do we expect to receive over those 5 years? And essentially the return is the income plus the capital over that 5-year period. The bottom-up analysis for us is highly dependent on the analysts getting out and talking to the companies, visiting the assets, talking to suppliers, talking to customers, importantly talking to regulators and other parties around the business such as financiers. That helps us test the longer term assumptions that we're putting into our financial models. These are long-term assets, and so you need to understand what's going to happen to the asset over the next 10, even 20 years in terms of capital expenditure profiles, revenue growth, what's going to happen to their cost base and their margins over that time period as well. So it's a very data-intensive process. All of that work goes into our financial models, and that drives the bottom-up analysis that we as value managers undertake on the companies.
How do you factor risk into the equation?
Well, it's an interesting point. The investment coin has 2 sides, right? On the one side, you've got the return that you expect from an investment, but you can't take a return into your portfolio without considering the risk portion of the equation. And so for us, there's a clear delineation. The return calculation is driven from the research process. And as portfolio managers, we have input to that. But it's the responsibility of the analysts to say, this is my best estimate of the returns you will receive over the next 5 years. The risk portion needs to come back to the portfolio manager. So the PM has to say, if I take that return into my portfolio, I'm taking a certain amount of risk. Therefore, what return do I specifically require to take that asset into my portfolio? And for me, we start with the cost of equity. So what's the benchmark equity return? We add a premium or a discount for the volatility of the stock. So ultimately, we want our portfolios to be moving towards lower volatility of returns. We look at the liquidity of the underlying positions. So if I'm taking a less liquid stock into the portfolio, I actually want a higher return for doing that. We look at environmental, social and governance issues, and we price that risk. And finally, we have an element of comfort level for the portfolio manager, specific risks that may be in the market today, and we take that into account in terms of the total return that we're looking for from an investment in a particular stock.
So if I'm an investor in one of your funds, what does that mean for me?
So Matt, as an investor in one of our portfolios, what it means is that we are managing the risk in that portfolio quite closely, and risk translates into volatility of returns. So over a full cycle, 5 years or so, it shouldn't cost you anything in terms of total return, but what it should mean is that the volatility of your returns over that period should be lower than you might see with other managers.
Nick, thanks for joining us.
Matt, it's been my pleasure.